You are watching Trading Day. I'm Amber Canmore. We are watching the markets reacting pretty positively to new job data. This coming in the form of jobless claims, not increasing as much as expected, only 233,000 jobless claims. That is less than the prior week and below what was expected. Let's bring in Wu Silverman, who's the head of derivative strategy at RBC Capital Markets. This is just one data point that probably wouldn't matter so much, right, Amy, if we weren't so obsessed with what's going on in the job market, if we didn't get spooked last Friday by the tepid growth in the United States. What do you make of today's reaction, what it says about the mood?
Yeah, it's certainly been a tumultuous market, Amber, particularly this week. And I think, look, the market is going to be incredibly data dependent. And you see that in the volatility. So volatility itself, the VIX has dropped back into the 20 handle levels, but the volatility of volatility itself, the VVIX still remains quite high. And it's essentially the market telling you that there's still nervousness under the surface, and all these data points will really contribute to what the narrative is going to be going forward.
I think that's a good point about volatility. We saw it spike up to crisis levels, like severe crisis, like financial crisis and the pandemic. You know, and it's certainly come back down to earth. But to your point, we're still hanging around elevated levels. Do you think it holds, or does it go back into its slumber? How do you think about how we progress on volatility from here?
Yeah, it's a really interesting question. It's one I've been very focused on. Look, when you look to history, when you get these spikes, of course, volatility itself comes back down to earth, and you have a lot of volatility sellers come in and kind of take advantage of that fact. But look, looking longer term, so in the weeks, months ahead, particularly as we get to year end, I think we stay at elevated levels because it's not just about the data. There's also a U.S. election ahead. And I also think that investors have woken up to the idea that all the hedging that seemed unnecessary when we were in kind of the FOMO, MOMO parts of the year towards the beginning are actually quite necessary. And you are seeing that rise in people demand protection on their portfolios and realizing that, you know, Mag 7 can't necessarily hold everything up, and there could be some things that actually need protection.
Well, let's talk about that in the context of earnings. You can buy protection, to your point, on your overall portfolio. You can buy it on specific stocks that you own. And we saw just this punishing reaction to particularly these tech stocks when they reported results.
Yeah, that's exactly right. And this is actually something that I think is quite interesting. We've been talking about for a while, which is when we got into this earnings season, this was the first earnings season where you actually did not see the right tail of the market in the Mag 7. So that call exuberance, that demand for upside, which was there in every single earnings season since NVIDIA reported May of last year, it was not there. It was the opposite. We saw very bearish sentiment. And I think, you know, there was something to that because AI has become a little bit more of a show me story. And you're starting to see these moves on earnings day beat their options implied moves. Now we have a big one ahead, NVIDIA, which we haven't seen yet despite the volatility. And I do think there are going to be traders who are going to start positioning trades, specifically given the market weight of a name like that.
NVIDIA, we haven't got earnings yet. What are you seeing? What is the options market telling you?
Yeah, two things there. First, that right tail that we've seen really bid up, so meaning people really pursuing upside. We've seen that every single quarter since May of 2023. That's largely absent. And there is, in general, more interest in downside hedging. Even with the moves we've seen already, I think that's quite interesting. And then overall, because it plays such a large weight in the S&P and in NASDAQ, you're also seeing more demand both for protection there, but also for different structures that take advantage of the fact that implied volatility has gone and risen versus, you know, prior to this week, it was actually relatively subdued.
Do you think the volatility around the unwinding, as it were, of the so-called carry trade is behind us, or might we see that play out a little bit further? Depending on how the next couple of weeks go, we have inflation next week. You've got this Jackson Hole speech by the Fed, which will be the real table setter for the September rate move. How do you think about that on a macro level?
I think that's such a good question because, you know, when these spikes happen in volatility, there's always more than one culprit. Of course, the carry trade with yen USD was a big part of it. But look, underneath the surface, there's also a lot of other positioning trades going on, whether that's coming from, volatility selling ETFs or from the structured product space or from different volatility targeting CTAs. There are many different culprits. It's not necessarily one. So I think the answer to your question is yes, for the ones that we kind of are the most aware of, a lot of that unwind has occurred, but that's not true across the whole spectrum of different trades that have piled up because volatility has been so incredibly low. And that, of course, has been in itself a self-fulfilling prophecy. And I don't think that aspect is quite finished yet as we go to other data points that matter quite a lot to this market.
We talked about people buying protection for possible downside, but then I think about other moves, like McDonald's. It had its worst sales since the pandemic, first sales drop since the pandemic, but the stock rallied. Is there incrementally more bullish activity on the S&P 490, on the back of what has been that rotation trade over the last month, or is that not really giving you a decisive direction right now?
Yeah, it's interesting you say that because one of the biggest questions I get is this the time in the sun for IWM? For small mid cap, something other than AI names, tech names, mega cap tech names. And what I will tell you is the sentiment there hasn't really flipped. So we did get, this pocket where you did see that outperformance. Sentiment was quite bullish, but that hasn't reappeared. So the options market at least isn't quite saying that it's time yet for that full-on rotation to take place. Now that could change. We did see that November of last year, but so far it's been relatively short-lived, even when we do see that exuberance. And I think, look, it is a stock player's market in the sense that it does change stock by stock, but on an overall basis, when we look at those ETFs that hold more of those big 7 names, you don't see that sentiment shifting quite to the positive side yet.